interviewing the leading private equity executives and unlocking the secrets of success. Welcome to the Private Equity Podcast with Alex Rawlings.
Welcome back to the Private Equity Podcast, interviewing the leading private equity executives and unlocking their secrets to success. Joining us today is Jeff Gendel, Principal at Gen 2 Fund Services. Welcome and thank you very much for sharing your insight into the industry today, Jeff.
Alex, thanks for having me. Looking forward to our time together.
Perfect. So, Jeff, as we always begin, if you could give us a 60 to 90 second breakdown of you, please.
Sure, happy to do that. So I've been at Gen 2 about 8.5 years and in the private equity industry for about 25. I spent a long time in the media business, so the whole podcast thing is very interesting to me. And I created something called the Private Equity CFO Forum along with another person. And that event really today continues to run as the leading private equity CFO conference. My whole network has been built off of that event and other similar events, and I've spent a long time cultivating. Let's stop that, Kim, or whatever. I got a better intro for me. I got to think about this a little bit differently. So, because you want my background, I got to think about it with respect to the operational infrastructure. Let me. I don't want. It's not about PEI. It's about me. Okay. So I'm gonna take a mulligan on that, and you can ask me the question again, and I'll go ahead and start it.
Okay, so Kane, cut that bit out. So, Jeff, as we always start with this question, share us a 60 to 90 second breakdown of you, please.
Sure. Well, thanks very much, Alex. So I've been at Gen 2 for about the last 8.5 years, and I spent about 25 years dealing with the operational side of private equity. And the people in and around them, both private equity firms and service providers, technology firms that have operated in the space. And I've seen quite a bit since the time I've started in this industry as the importance of operations continues to grow and the professionalism of the service side of the business continues to grow. And I'm certainly happy that it maintains the important place that it does in the space. I sit in our New York office. I have overall responsibility for our business development efforts, and I'm really supported by a fantastic team of over 825 professionals around the globe that deliver fantastic service for our customers all day long and essentially allow me and my team to do what we do, which is sell our services to new private equity firms every day.
Certainly a lot of people, Jeff. I'm sure that keeps you pretty busy. So what's one mistake that you see private equity firms making, and what actions would you suggest for them to correct it?
Yeah, well, it's interesting. Private equity firms have been started by deal people, and deal people know how to do deals. And only in the second private equity revolution, which I'll really say started in the mid 2000s, did you really see operations becoming a focus. Perhaps it was because of Madoff. Perhaps it was because of other issues that occurred on the operational side where information was not delivered to LPs as they wanted it. I recall at one of the first conferences that I ran in a previous life, Steve Schwartzman got up in front of a group of CFOs. And this is a group of CFOs that had never really been talked to in an endearing sort of fashion. And Steve Schwartzman gets up and says, "The private equity CFO in my firm is the most important person in my firm." And everybody kind of took notice, sat up in their chair and puffed out their chest and said, "Wow, Steve Schwartzman thinks I'm important." And I think that was among the seminal moments, at least in my career, where the operational side of the house became important. And prior to that, you could make the argument that many people on the operations side of the organization did not feel loved, did not feel that they were important, did not feel that they added value. And over time, you've seen that individual on that team become an integral part and a vital part of the way private equity operates. And as evidenced by the DDQs that come into play, the requirements of organizations like ILPA to ensure that they and their members are well aware of how private equity firms operate operationally. And so those firms who are not focused operationally and simply care about getting deals done are missing an opportunity to elevate themselves as a premier firm in the private equity space. These days, just about every LP has an operational due diligence questionnaire, every significant LP. And they're not giving the private equity firms a free pass on that, as they might have 7, 8, 9, a dozen years ago. And so, to round out the answer, Alex, the biggest mistake that I see people make is paying lip service to the operational side of the house. Fewer and fewer firms are doing that these days, much to my pleasure, and obviously I think to LP's pleasure as well. And at the end of the day, those are the organizations that we have to serve, and if we do a good job for those LPs, then the private equity industry as a whole will benefit.
Yeah, I agree. I think there's a lot more. We've certainly seen a lot more focus around bringing in top quality chief financial officers, top quality COOs into the firm, etc. And we've definitely seen a lot more of that. So I can definitely see there's definitely a shift there. But you're absolutely right. These guys are deal makers, and that's what they focus on. Their focus isn't usually their skills in building the back office infrastructure of how to run a fund. It's how to identify a good investment, win obviously that piece of business, and then be able to then grow that and obviously exit it fundamentally from there. So I'm interested, obviously, as your view into private equity, what are some of the kind of trends and challenges that you see some obviously the private equity firms facing from a back office, if you want to call it that, perspective?
Yeah, well, there are a multitude of challenges these days, and they all have some risk component to them. There's risk of execution. There's performance risk, there's human capital risk, there's regulatory risk, and those all play a big part in the day-to-day operations of a private equity firm, and we see that with increasing intensity today. So what generally I like to categorize it is as a risk analysis that a private equity firm undergoes on a regular basis to understand if their internal organization has the ability to meet the demands of the various constituents in the organization, whether that's their LPs, their internal general partner reporting requirements. Increasingly, we're seeing private equity firms sell a third-party stake, sell a piece of their business to a third party. And with that comes an additional set of reporting requirements. We're seeing them have to deal with human capital issues like every essentially service business and every industry is dealing with these days with respect to the people in their organization. And so many private equity firms have grown significantly in size. And as anybody will tell you, the larger an organization you have, the larger risks you have, and the more you need to insure against those risks. So what I've seen broadly is a different take on risk analysis within the organization, and the operational side of private equity has become a major part of that risk analysis, where 10, 15 years ago, it was not a part of that risk analysis at all.
Perfect. And we identify a few of those areas. So fundraising, what's your kind of take on, what's happening currently with fundraising? There's a lot of dry powder in the market. How are you kind of seeing things?
Well, fundraising is always an interesting topic. Today, we've seen probably more of our clients, and we service about 220 clients worldwide, and some of the most venerable names in the private equity space. And so we have a good finger on the pulse of what's happening on fundraising. Those organizations and many like them are really fundraising at a breakneck pace. And we track this internally, how many of our clients are back in the market with new funds, more than ever. It's not just new funds, but it's new strategies. So you have a traditionally private equity shop taking the opportunity to raise a growth equity fund for opportunities that might be smaller than the traditional buyout fund, or perhaps a private credit sleeve that invests in similar industries and brings on a credit team to add to the overall asset mix that private equity shop has. So what we're seeing in private equity is not just an increase in the size of funds. And of course, you can look up just about any bit of research to tell you that private equity returns have outpaced most other asset classes. So private equity firms are raising money for their traditional, what I'll call flagship funds, but they're also raising money for other asset classes, perhaps private credit. Perhaps I've seen some firms raise an infrastructure fund they invest in, for instance, medical device businesses. So they're raising a real estate infrastructure fund to buy properties that might one day house the businesses that they invest in, the healthcare businesses they invest in. So really brand extensions. And then combined with the demand for co-investment activity, what we're seeing is really an explosion of entities across private equity firms. And that has impacts on LPs ability to focus and spend time on opportunities. And so every LP is stretched these days. Few LPs have excess capacity to invest in new private equity funds. And that also has an impact on a very important part of the market that we spend a lot of our time with is emerging managers, first-time funds, and people who have spun out of a large private equity shop to hang their own shingle and start up business. And so in the last several years prior to 2022, emerging managers were very active. We had probably a record number of private equity first-time funds in the market in 2021 and after the pandemic started to lift at the end of 20. And because of the reasons I mentioned before, legacy private equity firms coming back to market, and virtually everyone's back to market with something these days, it's been tougher and tougher for those emerging managers to get visibility and traction with LPs, because simply LPs have less bandwidth and less capacity. So it's impacted the fundraising timeline. It's expanded the fundraising cycle. And then as it relates to the operational side of the house, every time we are in a fundraising cycle, we see a whole new set of questions that come about from LPs with respect to operational due diligence, reporting, cash management, controls, things of that nature. And so that's an ongoing evolutionary process that we get a front seat for.
Interesting. You mentioned one of my favorite topics, obviously, running an executive search firm is human capital. What are you seeing from that perspective?
Well, I don't run a human capital business. I kind of hear about it. You might be better positioned than I am to talk about where things are going in that respect. But the talent is always at a premium, and the best. I like to use sports references. The best athletes are always at a premium, and to use our soccer/football reference, it's tough to get a good striker or a central midfielder to anchor your team. And so we're always on the lookout. We are, as our organization, our competitors, the industry in general is always on the lookout for talent. And I don't think that we are seeing any differences in our industry as other industries are with talent. I think the global talent war is full steam ahead. And so it's going to continue to be a challenge for us. You probably know better than I do because you're sitting at that front line. But I give credit to our human capital folks. They've hired more people this year than we've ever hired. But broadly speaking, across every industry, and ours is no exception, turnover is also at its highest. So figuring out how to deal with that without rampant uptick in salaries, which is not really sustainable for anybody in any business. That's the challenge. And so I leave the human capital riddle to folks like yourselves and the experts at our firm.
Makes sense. Makes sense. One thing I think from when we look at the back office team of a private equity firm, I think there's a lot of reliance on individuals to have very lean teams. And I think private equity as a whole is usually particularly quite lean. And therefore what you find is the back office team are usually incredibly lean. you'll have a CFO. You may have a controller in some low and middle market firms, but a lot of it will be a CFO and then utilizing someone like you. Do you see anything specific with regards to the people that you're interacting with when they're obviously like a CFO in a private equity firm? Do you kind of see anything different from that perspective? Do you guys see quite a lot of churn on that basis, or are you always dealing with the same faces?
Well, there's churn in every industry, right? And I don't think that private equity is any different on the operational side. So every business, private equity or non-private equity, wants to retain the best talent. In businesses that are traditionally flat organizations that don't have a huge matrix type of setup, it's very difficult to move up. If you think about a private equity controller, for instance, the likely path for them is to move up to the CFO role, or if the CFO is entrenched in their position and not moving, it's to move out. And so for a private equity firm to recognize their human capital and figure out how to best deploy that human capital in perhaps a different role or a more expanded role, maybe not a CFO role because the CFO is not leaving, or maybe if the CFO does transition into maybe a chief administrative, chief operating officer. Not everyone's fit for that, but some are. But the management of human capital continues to be challenging. You have a few levers, as you know. You can change titles, you can change roles, you can importantly change salary, compensation, maybe include them in the carry pools. But we frankly see private equity firms deal with it in many different ways. Some of them are experiencing, because you mentioned about lower investment in the operational side than perhaps in other areas. So in the instance where that happens, we see that from time to time, and people move out, then I'll get a call. This happens quite regularly. I'll get a call from a contact of mine who tells me that, I just had someone go on maternity leave, and I potentially have someone else who's leaving at the end of the year, and so I have a human capital risk, and how am I going to ring fence that risk? And so we talk through the options, and we talk through what something like outsourcing can do to manage that risk. And so I think that firms that have not invested in their human capital are starting to see a greater risk in their teams. And again, getting back to my previous comments, how do you manage that risk? How do you insure against it? There are a number of levers you can pull. Outsourcing is one of those levers. And as I put my business development hat on, I want to be here for those conversations.
Sorry to interrupt here. Just a quick note to highlight our new sponsor, Grata. The private equity market is rapidly shifting to a data-driven, proprietary deal sourcing standard. Grata provides the window into over 7 million middle market private companies. Contact Grata so you can access the market first. Request a demo at www.grata.com. Now back to the podcast. That makes sense. And you mentioned CFOs in particular there. Reporting, is a particularly poignant point within any area of private equity, no more than chief financial officers. What do you see as kind of some of those pain points for PE firms and particularly CFOs when it comes to kind of reporting demands?
Mm-hmm. Well, there's few LPs that say, I want to see less information. So everyone wants to see more information. And so then it's a question of, well, what type of information do I want to see? So the most important information that LPs want to see is, well, how am I doing? How's my investment doing? And try to see it not just in the traditional, what I'll call one fund to one LP reporting relationship. They want to see it in a total relationship fashion. So how is my total investment performing with your firm? And so if you're a private equity shop that has a multitude of strategies, as I talked about earlier in our time together, you want to be able to produce a report that covers your performance across perhaps the private equity and the private credit and the co-investment business. So the ability for a firm to be able to do that is, I think, one of the things that separates the better reporters from the not so good reporters. And I'm not talking about reporting from a performance perspective. I'm just talking about the ability to aggregate or disaggregate as needed performance across any metric that LP wants to see. You have, for instance, some state pension plans in the US who really have an interest in seeing the exposure that they have to their home state. So you want to be able to identify, in California, for instance, what are my California investments doing and how are they performing for CalPERS, the largest LP in the States. So the information demands are much greater than they've ever been. We hear a lot of talk about ESG. ESG is certainly a topic of interest for us. There does not seem to be, in my opinion, full consensus on what ESG reporting really means, and it varies from LP to LP. So I think the jury, if you will, is still out on what ESG reporting really should look like, because every time you talk to an LP, you might get a different answer. And so the reporting requirements are, again, to my earlier comment, no one's saying I need less information. Everyone's saying I need more information. And the key to the private equity shop is to understand what information that LP needs it in, and be able to develop either through their own technology or using a third party's technology like ours to be able to deliver that information in a fashion that is meaningful in their conversation with those LPs. Quarterly meetings, face-to-face meetings, not simply dropping it off in a mailbox for someone to pick up, but really having a crucial face-to-face conversation with those LPs. How can you dig deep on the performance of the organization, whether it's just simply nominal performance or ESG or fee discussions? Reporting is always going to be at the forefront of the LP's mind, and therefore it's at the front of the GP's mind.
Interesting. And you talked a lot about reporting. Moving from one art to another art, regulations in the SEC. Obviously, as an outsourced firm, what are you seeing as some of the trends and areas that, obviously, as private equity becomes under more scrutiny, that you guys are seeing from having to keep up on the forefront of things because you need to advise your clients on it, whereas private equity probably a little bit behind and waiting for guidance potentially.
Yeah. Well, it always seems that private equity is under more and more scrutiny. No one ever says it's under less scrutiny these days. And I was in the room during the famous Sunshine on Private Equity speech. And if your listeners are familiar with that, if you're not, you can Google it. So there was a famous speech by one of the SEC lead examiners about shedding sunshine or light on private equity and the opaqueness at the time, probably in late 2008, 2009, on private equity's disclosure, specifically about fees and expenses. And we're continuing to see private equity examiners dig deeper onto the riddle, in some cases, of private equity expenses. How are they allocated? How are they disclosed? If you look back at history, you see a number of instances where private equity firms have gotten, I'll call it a proverbial slap on the wrist by the SEC for either lack of disclosure or not following the rules that you've said you were going to follow. And those are really the areas that when I talk to folks who are close to the SEC, that they make sure that they make clear, which is have a rule, make sure it's a reasonable rule, and make sure you follow it. And ask the SEC a question in advance if you're not sure if the rule is applicable or not, or appropriate or not for you. And so things these days like allocation of expenses across co-investment vehicles, broken deal fees. Should co-investors also participate in some sort of broken deal fee as opposed to just the fund participating in broken deal fees? These are some things that we hear, and I'm not going to give an opinion on it because I'm not an SEC expert, but those are some of the conversations that we're privy to in our role and contacts in my network about those challenges. And so the SEC is always going to dig deep. They're a lot smarter these days than they were about private equity 10 years ago, where they'd walk into someone's office and say, let me see your trade blotter. And my CFO friends would chuckle and they said, you don't really understand what business we're in, do you? So the one thing I know is the SEC is much smarter these days about private equity, about how it operates, about some of the the ways that fees and expenses are disclosed and then allocated, and then the execution of those fees throughout the private equity ecosystem. And so they're going to get smarter about it. And the most important thing, as I said before, is to have policies that are practical, that pass muster with the SEC, and then ensure that you follow them to the letter in every instance. So when the SEC comes knocking, and they will, you have an appropriate audit trail to be able to show them that you're doing what you said you'd do.
Absolutely. So talked about quite a few challenges facing the kind of back office, if you like, of private equity and fund administration. How do you kind of feel all these challenges impact the kind of private equity firm's ability to scale?
Well, I think private equity has shown a unique ability to scale over the 25 years that I've been involved in the industry. Just take a look at the evolution from cottage industry and barbarians at the gate and KKR and the LBO universe to now publicly traded private equity firms. Take a look at the evolution of the venture capital market from a bunch of college professors who all kind of cuddled together and kind of it's just right near Stanford University and put their money into some venture capital funds. And now it's a global industry with LPs. Like I remember when the state of Michigan wanted to get into a very well-known venture capital fund, and that venture capital fund refused to give that pension plan any information about their portfolio companies. And it was a seminal moment in our industry. That wouldn't happen today. So the only reason why private equity firms are able to scale is because they've provided additional information disclosure, obviously great returns, and they've been able to attract capital because of the ability for those firms to essentially outperform other asset classes. So we talked about scalability earlier with respect to other assets. So adding a private credit fund or adding a growth equity fund alongside a buyout fund and similar types of strategies, we're continuing to see that happen. And so the front office side, the investor relations side of the private equity shop sees immense opportunity for scale. And the challenge is to make sure that the operational side of the private equity shop can manage that scale along with the fundraising pace. We are, I think, a beneficiary of that desire for additional asset growth, a beneficiary of that desire for additional strategies. And so firms come to us when they're looking to achieve scalability and meet those ongoing demands of their investors and not miss a beat as they try to report returns and other metrics that LPs want to track back to those LPs.
We've talked a lot about, what's happening or happened in private equity. What's your take on private equity industry's ability to scale kind of at the same pace it has done, as we've seen phenomenal growth over the past few years, or certainly post-COVID?
Mm-hmm. Mm-hmm. Well, look, on a macro level, I really believe that private equity will continue to be well positioned to capitalize on financial trends, wherever it may be. Sure, there's going to be some gyrations. There's going to be some. Look, is crypto going to be here to stay or not? I don't know. Is the interest rate environment going to impact private equity in a negative fashion? Now that, at least in the States, we've seen some significant increases in interest rates. I don't know, but one thing I've been able to see private equity do over the course of the last 25, 30 years is adapt more quickly than other industries, than other financial industries, to be able to meet the capital needs of the companies in which they invest and determine ways for the private equity firm, and importantly, their investors, who are obviously pension plans, police and fire employees, other public workers, to achieve outsized returns from those investments. So I really do believe that, again, macro level, you're going to see private equity firms be able to navigate challenges in the financial markets better than someone who invests solely in the public markets, who doesn't have a control premium, who doesn't have the ability to influence management, who doesn't have the optionality on the exit of their investment. So I'm very pleased to be in this industry, because I do believe, again, long-term macro, that private equity will continue to outperform other asset classes as it's done for the last 20, 25 years.
Bullish on private equity, but the jury's still out on crypto.
Yeah, well, look, there's smarter people than me who know which way that market's going. Although today I think it's down 10 or 12%.
Yeah, I've just seen that today. Dropped, Bitcoin's dropped. So yeah, it's an interesting one.
Yeah, I just see what it says on Bloomberg, but I couldn't tell you where it's going next. Did it outpace itself? Did it get ahead of itself? Is it just a retraction, or is this something different that's going on with respect to crypto? It's interesting. I read about this group called Celsius, which apparently lends against crypto assets, and they've essentially frozen activity in a number of their accounts. I haven't dug deep on it, but that is never a good sign when people feel their assets are frozen and they don't have access to their cash. That can cause some people to have a little bit of heartburn, if you know what I mean.
Yeah, I can certainly imagine. What do you?
I'm long-term bullish private equity, that's for sure.
Well, it certainly makes two of us, Jeff. What's as a provider into the private equity service or private equity industry, just like ourselves? What do you love about private equity, and equally, what do you dislike about it?
Well, you deal with some of the most intelligent, fast-paced, intense people in the industry, and I've been fortunate. Like, you'll probably get this in any industry where you focus your career, but I've been fortunate to have really been had a seat at the table for some rapid growth in our business, and watched some fantastic people do some amazing things. Any industry that you get involved in really is a small industry when you boil it down, and people know everybody, right? So I am grateful for the relationships that I've made, the relationships that my firm has made, the reputation that we have in the space. It's a dynamic industry. It's never anything I thought I'd get into after college. I never said, "Oh yeah, I'm going to be in the fund administration business for private equity." When I was going through undergraduate school, I never fathomed it. But I think that it never ceases to amaze me at its ability to create and innovate and deliver returns for investors. I know I repeated myself a bit, but it really is true. As far as what I don't like, well, you're putting me on the spot there, Alex. I'm not sure if there's something I don't like. I'm a competitive guy. A lot of people are competitive. Maybe if we took a weekend off from being competitive, it might lower the blood pressure a little bit. But like the old story about the frog and the scorpion, it's my nature to be competitive, and we always want to win. And so maybe if we took a day off from being competitive, that might be good. But I doubt that's going to happen. So it's the nature of the beast, and it's what I'm going to live with, and I'm awful happy to do it because I'm a competitive guy.
Absolutely. So if anybody wants to reach out to you, Jeff, post this discussion, how best do they get in touch, please?
Well, sure. My firm's website, Gen2, the number 2, fund.com, has my contact information on it. And they can find me through LinkedIn, of course. I'm an easy profile to look up, and you can probably best get me through there, and also through our firm's website. And most importantly, I'm happy to be engaged in a conversation about what goes on in our market. I've been having that conversation for 20 years, and I hope to have it for another 20 years.
Absolutely. Well, Jeff, thank you very much for joining us today, and obviously sharing your insight into the private equity and predominantly into the back office and probably less spoken about area of private equity. So thank you very much for that.
Alex, my pleasure. We talked a little bit of football before we got on the podcast, and good luck to your football team next year.
Well, they don't need it as much as they used to. We've got a bit of investment. The football team is Newcastle United, for those listening, and Jeff shared his is Tottenham. So I think it's you guys need a bit of spend on there, definitely. So to get you guys up there and finally get Harry Kane a decent trophy.
I think that's coming. I think the capital injection is going to help, and certainly the manager is going to help. And every team's a work in progress. Spurs are no exception to that. And so I'm optimistic about next year, as I'm sure you are about Newcastle.
Yeah, I think it's definitely more promising than its previous owner. We'll certainly.
You weren't an Ashley fan. You weren't an Ashley fan.
I don't think anyone was particularly an Ashley fan, although he ran it profitably. So good on him for that. But you run your business how you want to run a business, and sport is fortunately or unfortunately, depending how you see it, obviously a business, and better the situation than a Derby County who are going in administration and all sorts of other bits that are happening. So it's you can always, I'm sure there's plenty of firms that would love to be in a Premier League and under Mike Ashley rather than in League 3 or whatever it is, Conference League.
Lots of private equity investment into sports teams globally, whether that's Premier League, Italian League, French League, Spanish League. So not that I'm telling you, but if you put on that podcast, I'd listen.
Yeah, the CVC Capital invested in the Six Nations Rugby. So there's been quite a lot. And I know there's been quite a few firms invest in the Italian league. So yeah, it definitely would be an interesting one, actually. It's worth us looking into. So yeah, again, thank you very much, Jeff. I really appreciate your time and insight. And as always, thank you very much for everyone listening, for joining us. Should you ever need any support with private equity professionals or portfolio executive hiring across Europe and North America, please do reach out to me at Raw Selection. But till the next time, keep smashing it and all the very best.
Thank you for listening to the Private Equity Podcast on www.raw-selection.com.